Hello, and welcome back to the demo portion of our lecture series. Now, in this video, we're going to kill two birds with one stone. In the prior video, we went through all the ratio analyses, right? And I figured instead of doing two demo videos dealing with ratio analysis, we'll just do one. And we're going to demo the homework problem, okay? So if you pull up the B exercises, we're going to work on problem 18-2B, okay? Now, what I did was I went to the PowerPoint slides, and in the lecture video, I said, hey, there's two slides, specifically 18-49 and slide 18-50. They give us all the ratio, or they summarize all the ratios. They give us the ratio, they give us the formula, they give us the purpose or the use, okay? I printed those out and have those in front of me. We're going to walk through, and to be honest with you, this is super easy. It's almost redundant, to be honest with you, but that's okay. I just kind of want to model how you do ratio analysis. So the first thing that we need to look at here is problem 18-2. They give us a comparative statement of Docker Tool Company, and they give us their income statement, they give us their balance sheet, and then they want us to do a number of ratios, right? So if you'll notice here, the first one I have is the earnings per share ratio. And literally what I did was I looked at the book and said, they want me to calculate the earnings per share ratio. No problem. I have my two slides printed out. I'm going to find my earnings per share, and I see how to calculate that, right? It says I need to take my net income minus any preferred dividends. Well, I left that out. Why did I leave that out? Well, because this company doesn't have any preferred dividends, so I don't need to subtract zero, okay? And then we divide by the average common shareholders' equity, okay? What are we measuring here? Well, we are measuring the profitability of owners' investments. Oh, scratch that. I apologize. We're measuring net income earned on cash on each share of common stock. Okay, that's what we're measuring. So I need to go to my balance sheet, or excuse me, my income statement, and I need to grab the net income. Well, the problem tells us that the net income is $210,000. So I'm going to plug that in. 210,000 divided by the average common or weighted average common shareholder outstanding. Well, in order to find that information, I need to go to the balance sheet. And if I read through the problem, they give us some additional information, right? And if you notice, it says that they want us to compute the following ratios for 2017. And they tell us, hey, by the way, the weighted average common shares in 2017 were 62,500. That's our number. Okay. So I just run the numbers equal $210,000 of net income divided by the weighted average common shares, which is 62,500. I get $3.36. Okay. Now, B wants us to calculate the return on share. I'm going to abbreviate here, okay, and say SHE. That stands for shareholders' equity. Okay. How do I calculate that? Well, again, I either know it by rote memorization, or I can just look it up on my PowerPoints. So we see that the return on common shareholders' equity is calculated by taking the net income, and we have to divide that by the average common shareholders' equity. Okay. by average common shareholders' equity. Okay, so how do we do that? Well, that's pretty easy, right? I'm going to take my net income, which is $210,000, and then I'm going to divide it by these average common, by the average common shareholders' equity. Okay, what numbers do I need to pick? Well, if I go to the balance sheet, I can see that in 2016, the total shareholders' equity was $465,400. In 2017, it was $556,700. Okay, I just went to the balance sheet and I looked at total shareholders' equity. So to figure out the average, I need to to figure out the shareholders' equity, I need to add both of those up and divide by 2. So I'm going to say 465,000 plus 556,700 divided by 2. That is my calculation. It's not a little bit, okay? So I'm just going to go ahead and run the numbers in Excel. 210,000 divided by, open parentheses, my total shareholders equity of 2000 from 2016, 465,000, plus total shareholders equity from 2017, 556,700. Close, divide by 2, close parentheses. And that did not work out right. That's because I missed a parentheses there. Okay, there we go. So if I turn this into a percentage, I get 41% or 41.1%. Okay, C wants us to calculate return on assets. Oh, wrong spot. C. Return on assets. So I don't know. I forget what's the formula to calculate return on assets. Well, no problem, right? Because I have my cheat sheet, or literally two cheat sheets of the ratios. So I'm going to look up return on assets, and if you remember, return on assets is calculated basically by taking the net income. So we're going to take our net income, and I'm going to divide by the average total assets. So I need to look at my my balance sheet, and I can see that the total assets for 2016 was $852,800. So I'm just basically going to add up the assets and divide by 2. Super easy to do, right? So I'm going to take my, let's see, $852,800 plus my $970,200, divide by 2, and that will give me, oh, I'm so sorry. Just bear with me here for a second. Let me fix this. Okay. So to figure this out, I'm going to take my average. I'm going to divide by my average total assets. And we just figured out what our average total assets, or I showed you how to identify what the average total assets are. The net income in the problem is still the same. It's still $210,000. That did not change. Okay. Then I run the numbers. 610,000 divided by, open parentheses, 852, 800 plus 970, 200, close parentheses, divide by 2, close parentheses again, and I get 23%. Turn that into a percent. Okay, that's the return on assets. Now the next thing we need to do per the problem is determine what is our current ratio. So that's an easy one, D. And remember, current ratio measures liquidity. So how do I calculate the current ratio? Well, that's easy. To calculate it, I need to take my current assets and divide it by my current liabilities. Okay, so what exactly are my current assets? Well, I need to go to the balance sheet, and notice they give us very nicely, hey, here's your total current assets. In 2017, because that's what we're calculating, 2017 numbers, we're going to take the current assets, which equal 364,900, and we're going to divide by the current liabilities. So if we scroll down the balance sheet, we see total current liabilities for 2017 are 203,500. So we type that in, 203,500. We run the numbers, 364,900 divided by 203,500 gives us 1.79, okay? Basically, it's 1.79 to 1. And that measures the short-term debt paying ability of the company. So for every dollar of liability, the company has current assets of $1.79, okay? So again, remember from the lecture video, by that self, that means nothing. If we think about it as a rule of thumb, that's a pretty good number based on the rule of thumb, right? Excuse me. The next thing we need to calculate in letter E is going to be the acid ratio, or the acid test ratio. Okay, so how do I calculate the acid test ratio? Well, that's easy, right? In order to do that, I need to take my cash plus my short-term investments plus AR net and I divide that by my current liabilities, and I'm going to abbreviate and say CL. Okay? So what numbers are we using? Well, that's pretty easy. Remember, we're calculating for 2017. So I'm going to take, there's a number of ways you can do this. You can take your cash, which is $60,100, take short-term investments, $64,000, and take net accounts receivable and add them all up, right? We could do that. There's an easier way to do it mathematically. And let me show you here. So 60,100 plus 64,000 plus 122,800. And I'm going to divide all that by my current liabilities, which is still 203,500. Now, mathematically, to do this, I'm not going to add all those up. That's a pain in the butt, right? What's the only, if you look at the balance sheet, under the current liabilities, we know our total current liabilities is $364,900. Cash, short-term investments, accounts receivable, and inventory make up those numbers. If I want to figure out what my assets are, I'm just going to take the, $364,900, which is my total assets, minus my inventory. Okay? Then I can divide by my current liabilities. Okay? So I get 1.2 to 1 and 1.21 to 1. So that means for every dollar of current liabilities, the company has an assets of $1.21. Okay? The next one we have, F, looks at accounts receivable turnover. Okay? So what is accounts receivable turnover? Well, when we're talking about accounts receivable turnover, it is a liquidity ratio, and we calculate it, bear with me here, and I'm going to abbreviate here, AR turnover, okay? And we calculate that by taking our net credit sales and divided by the average net AR, okay? Okay. Now, what numbers do I need to pick? Well, it's pretty easy, right? We go to our income statement and we say, okay, what is our credit sales? Well, they tell us in the problem that the net sales are $1,828,500, but we don't know if those are cash sales or credit sales, right? Luckily, the problem tells us underneath the balance sheet, hey, all sales were on account. Perfect. That's all we need. Okay. So what we're going to do is we're going to take our net sales of $1,828,500, and we're going to divide by the average net accounts receivable. So we need to go to the balance sheet for that, and we find our accounts receivable net. We have $102,800 for the end of 2016, and we have $122,800 for 2017. So if I want the average of those, I'm going to add them up and divide by 2. So I'm going to take my 102,000. Excuse me. I'm going to take my $102,800 plus my $122,800. I'm going to divide that by 2, and I'm just going to run the numbers. So my net sales, 1,828,500 divided by open parentheses, then open parentheses again, 102,800 plus 122,800, close parentheses, divide by 2, close parentheses again, and I get 16.2. Make that down. Oh, wrong way. Okay, 16.2 times. So what's that mean? Well, accounts receivable, they turn over their accounts receivable 16.2 times per year, and that measures the liquidity of accounts receivable. Okay, the next one we have to do is going to be G, and G is inventory turnover. I'm going to abbreviate TO for turnover, okay? So how do we calculate that? Well, that's easy. We take the cost of goods sold and we divide it by the average inventory. Well, that's easy, right? So we're measuring inventory turnover, which incidentally measures the liquidity of inventory. So I'm going to go to the balance sheet, or excuse me, I'm going to go to the income statement. And what I'm going to look for is my cost of goods sold. And we see here that the cost of goods sold are $1,010,500. We're going to divide that by the average inventory. Well, what's my average inventory? I got to go to the balance sheet for that, right? And if I look, my inventory for 2016 is $115,500, and for 2017 it's $118,000. So I'm going to add these up, divide by 2. Okay, 102,800 plus 122,800 divided by 2. Now, mathematically, I'm just going to run the numbers in Excel. So I do my $110,500 divide by open parentheses 102,800 plus 122,800 close parentheses divide by 2 close parentheses again, and I get 8.9 bear with me here. 8 point, actually, we're just going to go 8 point, or we'll go 8.96 times, right? That means that they turn over their inventory 8.96 times in a year, okay? H wants us to calculate times interest earned, okay? Okay, and if we're trying to figure out what the times interest earned is, we're basically looking for what our EBIT is, right? And we divide it by our interest expense. So how do we find out what our EBIT is? Well, that's really easy. It really is, right? They don't give it to us in the problem, but we can calculate it. We need to go to the income statement, and we need to take the net income. So we're going to take net income, and then to arrive at earnings before interest and taxes, we're going to add back the interest expense. We're going to add back, we're going to add back the income tax expense. And then we're going to divide by our interest expense. Super easy, right? So what numbers are we using here? Well, my net income is really hasn't changed. That's going to be, actually bear with me here. Oh, they give us the number, right? This income, or earnings before interest and taxes, or earnings before interest and taxes, that's the same thing as income from operations. So we don't need to really calculate that. We're just going to take the $302,000 they give us, and then we're going to divide by our interest expense, which they tell us is $17,000. And if we run the numbers, 302,000 divided by 17,000. We end up with 17.8 times. And again, that times interest earns measures the ability to meet interest payments as they come due, okay? So they can meet those interest payments that come due within a year based on their income from operations 17.8 times, okay? Let's see, one more, I believe. Yep, two. We have asset turnover and debt to assets. So I'm just going to bang those out real quick here. I is asset turnover, and J is going to be debt to assets. Okay, so how do I figure out then what my asset turnover is, right? Well, in order to figure that out, I need to take my cells. So I'm going to take my cells, and then I'm going to divide that by the average assets, right? Or the average total asset, which they tell us the total assets are 852,800 for 2016, 970,200 for 2017. So average total assets. So how does that look? Well, I'm going to take my sales, or my net sales, of $1,828,500, and I'm going to divide by my average assets. So to figure that out, I'm going to take the 852,800 plus 970,200 and divide that by 2. Okay. So to make us look even, to make Excel work and make it calculate, we got to use the following logic. I'm going to type in my net sales, 500, open parentheses, divide by, open parentheses, 852,800 plus 970,200, close parentheses, divide by 2, close parentheses. Oh, usually helps if you put an equal sign in there. So we basically get 2 times. Excuse me. So when we're looking for the asset turnover, we're measuring basically how efficient are the assets being used to generate those cells. And we get a number of 2. Again, by itself means nothing. We need something to compare it to. Okay. And then finally, we need the debt to assets. So to figure out the debt to assets, we take our total liability total liabilities, and we divide them by our total assets, right? So we're going to take $413,500, which are the total liabilities for 2017, and we're going to divide by the total assets for 2017, which is $970,200. We run the numbers. We get 42.6%. Okay. So that is ratio analysis. We didn't do every single, I don't believe we did every single, I think we missed a couple ratios for the problem, but that's okay. We demonstrated how to do it, right? You need to know your formulas, and then you just go find the formulas or the numbers that fit in the formula, and you just plug and chug basically, right? I strongly encourage you to print out those, those 2 or 3 slides that have the ratio analysis or the summary of the ratios on them. That will help you with your homework assignment, okay? The point of this was to demonstrate how to kind of do it, right? Identify sources that we can use. We have our our cheat sheet, so to speak, the summary of ratios. And I wanted to demonstrate what, which you should know by now, hopefully, what financial statements you go to pull out the numbers you need. Okay? So we demonstrated ratio analysis. We demonstrated horizontal and vertical analysis. So you're good to go for your homework problems. Okay. If you have any questions, please feel free and text me. I'd be happy to assist you in any way that I can. So thanks for tuning in, and we'll see you guys next week.